Good afternoon, everyone. My name is Matt Quinn. I'm the Director of Government Relations and Communications for the Illinois Restaurant Association. I'd like to thank you for joining us for expert tax and legal tips for right now. This webinar is being presented by the Illinois Restaurant Association in conjunction with the Cook County Small Business Assistance Program. Now, as restaurants, bars, hospitality businesses prepare their operations and head into spring and summer, today's webinar, we will hear from legal and accounting experts with some valuable finance tips and important employment law updates for the hospitality industry. Also, there will be a Q&A at the end of the webinar to get your questions answered. Additionally, this webinar is being broadcast in English, Spanish, and Mandarin Chinese. To listen in Spanish or Chinese, please use the interpretation button on your toolbar. Before we begin, I'd like to let everyone attending know that the Illinois Restaurant Association remains here as a resource to the hospitality industry as we continue to recover from the pandemic. Our staff is focused on providing guidance, assistance, and relief to restaurants, bars, caterers, event venues, other hospitality businesses, and allied partners throughout Illinois as we all work to emerge and operate fully again. We're sending regular email updates to thousands of operators around the state with what you need to know for your business, and you can sign up for those on our website. We also have a host of different resources and vendors that can assist you, information about current regulations, a pro bono legal network, and more on our website at illinoisrestaurants.org. So please feel free to reach out to the IRA team anytime. For the Q&A at the end of the webinar, you can use the Q&A button in your toolbar to post your questions at any time throughout the presentation. Or if you see that another attendee has asked a question that you like, you can hit the thumbs up icon next to that question so we can see which are the most popular. I'll be watching the questions coming in, and we will do our best to get to as many of them as possible at the end. Also want to let everyone know that we will be sending out the recording of this presentation as well as the slides following the conclusion of the webinar. Now I'd like to introduce our panelists and turn the floor over to them. With us today are Rob Bernstein, partner at Lehner Muchin, law firm Lehner Muchin, as well as Chad McCoy and Deanna Chang, both senior managers at accounting firm Plant Moran. So we're going to start today with Rob Bernstein. Rob, please go ahead and take it away.
Matt, thanks so much. It's always great to be here with the IRA. I've done so many of these educational programs on behalf of the IRA, and I always love doing them to keep our membership informed. So thanks for the opportunity to keep putting the word out there about a lot of important changes in the employment law area. And there sure have been. I was thinking about this before we started here. This is an area, employment law, where we're not quite at the pace of California yet in terms of some of the pro-employee, pro-worker laws, but there certainly have been more and more changes over the years in this area that employers and restaurants and other hospitality employers need to be mindful of from a compliance standpoint. So we have a lot to cover in a short time. I do want to say at the outset, as I always offer, if I spot something for you in the slides, don't have time to go into depth and into the issue, please, you have my email, you have my phone. I'm always happy, on behalf of the IRA to speak with you about, compliance related issues. So take advantage of that if you would like. The first area I want to talk about, let's go to the next slide. There's been a lot of legislative updates in the Illinois employment law sphere that are important for employers to know. And why are these things important for employers to know? The restaurants, other hospitality clients. Well, first of all, they impact, in certain respects, the language you have in your handbooks. To the extent that you're a restaurant that has an employee handbook, which if you have any number of employees, you should have, okay? It's important to make sure you're regularly updating that document to reflect the current state of the law. And I'm going to get to what I mean by that in a minute. But the second reason it's important is because it also impacts, from a compliance standpoint, your ability to follow the law and not step into landmines and make unlawful discipline and termination decisions of your employees to expose your restaurant or your employer to liability. And those are two main reasons why this why these things are important. But the Illinois Human Rights Act has been amended, okay, in a number of different ways recently. And the Illinois Human Rights Act is the state anti-discrimination law, which governs, I'm sure, everyone on this phone, because it's now been amended. And if you have one employee, you are governed under the Illinois Human Rights Act. And the Illinois Human Rights Act, just as the backdrop, is the anti-discrimination law that says employers in Illinois cannot take adverse employment actions, whether it be hiring, firing, discipline, promotions, wage decisions, based on a myriad of different protected characteristics, whether that be race, age, sex, sexual orientation, religion, you name it, okay? And the first thing I want to talk about, because this is an important amendment as of late, is conviction records, okay? What did it used to be like in Illinois in terms of the use, an employer's ability to use conviction records to make employment decisions? Well, it used to be such that, at least under state law, you could rely on conviction records to make employment decisions, okay? If you were being advised appropriately, you still had to pay attention to the EEOC's position at that time, or federal law, which said they didn't want you to blanketly rely on conviction records. You had to look at whether or not the conviction record bore a reasonable relationship to the job at issue. And you had to look at things, you still do, you have to look at things like, how long ago was the conviction? What was the conviction for? What is the job that the person's applying for, and how are they related? Okay. Has the person engaged in rehabilitation efforts, and are they a model citizen now? The EEOC all along has wanted employers to look at those things. And they said for a while now, employer, if you make employment decisions based on conviction records without examining those things, you are potentially running afoul of federal law, Title VII. Well, to make a long story short, in amending the Illinois Human Rights Act recently, Illinois has come in line, so to speak, with federal law by and large. And it's different, but it says that you can't rely on any conviction anymore. Okay. You have to assess whether it bears a reasonable relationship to, or a substantial relationship to, the job, or it has to pose some unreasonable safety risk for the employer. And then if you're going to rely on the conviction, this is very important. You have to engage in certain protocols before you can take the action as an employer. You have to give like a notice of adverse action and give the employee, 5 days to provide mitigating reasons as to whether or not, as to why the conviction shouldn't be considered. And then if you're going to terminate or not hire the person, you have to send them a letter which states that, and you have to put the information in from the Illinois Human Rights Department, the contact information, which I know is a great thing for employers, but that has to be done. Okay, so there's differences substantively in how you can use convictions, and there's protocols that need to be followed. Make sure that you are attuned to those. So to just cut to the chase, if you found out that one of your applicants at one of your restaurants had a conviction, and you just said automatically, we're not hiring them, well, you would have run afoul of the Illinois Human Rights Act now, okay, because you didn't follow those requisite steps. Matt, do me a favor. I want to quickly shoot through those couple other things on the prior slide, please. Yep. Work authorization status. That's another protected category. Okay. Now, so that's something you have to pay attention to. Association discrimination disability. That's another thing. And an example of that is where, let's say you have an employee who is married to a spouse, and the spouse gets cancer, and the spouse is covered on your restaurant's or employer's insurance plan, and the restaurant takes adverse action against the employee because the theory would be, at least from the employee's vantage point, that you're penalizing me or coming down on me because my spouse is running up your economic costs through the health insurance plan. That's the theory of association discrimination. Okay. And then reporting obligations. Every July 1 now, look under the Illinois Human Rights Act amendments. You have to report as an employer adverse judgments that were rendered against you for things like harassment and discrimination and retaliation by every July 1. So the next date now that's coming up is July 1 of 2022. And if you have any questions about that obligation, let me know. It's adverse judgments, okay? So that's what they're referring to. Next slide. The Illinois Equal Pay Act amendments have been amended. It's another state law. It's been amended in a couple different important ways. You'll remember, maybe some of you will remember, back in September of 2019, the Equal Pay Act was amended. And it said that if in the hiring of employees or the interview process, you cannot, as an employer, ask what the employee makes at their current employer, or what their benefits are, or what their salary history is. That's unlawful. That still stands, okay? So what can you do? I just want to be clear on this because I get this question all the time. You can certainly, as a restaurant, an employer, ask the employee what sort of expected salary range they want to make for you. You just can't ask about what they've made in the past or currently at their current employer. So this first amendment in red adds to this. Now, under the recent amendment to the Illinois Equal Pay Act, you can ask an applicant about any unvested equity or deferred compensation they may have at their prior employer. That's okay. Now, I realize I don't want to spend too much time on this because unless we're talking about a higher level management person at a restaurant group or at a restaurant, or maybe a chef, or maybe some other positions, this probably is not going to come up that much in the restaurant world. But nevertheless, it's an amendment to the act. The bigger one is that now restaurants and employers of 100 or who have 100 or more employees, okay, they need to, and who file EEO reports each year, they need to now file an Equal Pay Act certificate, okay, with the Illinois Department of Labor. And it needs to be done between the time frame March 24, 2022 to March 23, 2024. And you may be wondering, well, how do I get information on this? Well, first of all, you can look at their website, the Illinois Department of Labor's website. But I've already heard from certain clients that they've received an email. This must be the first batch of employers that they've received an email from the Illinois Department of Labor asking them to produce or submit the Equal Pay Act certificate by a certain date that's set forth in the email that the employer gets. So you pay attention to your emails. You should be getting an email at some point during this period. You may not be the first batch of employers who are going to get this email inviting you to submit the Equal Pay Act certificate and corresponding information. In the interest of time, let me just say this. There is a whole host of information that you need to submit in support of the Equal Pay Act certificate. I'm happy to walk you through that. You also can look at the Illinois Department of Labor website. There should be some stuff telling you what you need to do. But if you have any questions, I have been spending a countless amount of time with clients, walking them through the requirements of what they need to get ready to do. If you haven't heard from the Illinois Department of Labor for a while as to, inviting you to submit this, at some point you'll have to make a decision as to whether or not you unilaterally reach out to them. Because you do need to do this if you're 100 or more employees in that 2-year time frame. Okay, but it's my understanding that they are going to be initiating it to the employers that they have on file. Now, could things slip through the cracks? Of course they could. You can imagine how many of these they have to be concerned about and how much data is involved. All right, so important amendments, recent amendments to the Illinois Equal Pay Act. Next slide. I don't want to spend too much time on this because I don't think it's that pertinent by and large to the restaurant world. It could be to some of the bigger restaurant groups. Confidentiality agreements could be pertinent. The non-compete and non-solicits, I don't think overall are that pertinent to the restaurant world in my experiences, unless you're talking about a high-level manager or owner or chef maybe. But what this did, this is an important law that became effective January 1, 2022. And it involves the enforceability of non-compete agreements and non-solicitation agreements. And to be clear on what I'm talking about, a non-compete agreement is it is an agreement that contains a provision which says that you as an employee of that current restaurant or company cannot go compete for one of the restaurant's competitor, usually for a period of a year or 18 months or 6 months, whatever it is. And the non-solicitation provision is a two-pronged type of thing. It can relate to customers and it can relate to employees. Okay, we don't see these, very often in the restaurant world. It just, in many other industries that I represent, yes, but not as much in the restaurant world. So the bottom line is that this law did a few important things. It set salary thresholds that certain people needed to make if you're going to try to enforce or give them a non-compete or a non-solicit. If they make under that salary threshold, you can give them the non-compete or non-solicit, but they're going to have a good argument that it's unenforceable on its face under this new law. By the way, this law does not pertain retroactively. Some of you may be wondering, what if I had, a chef or a high-level manager sign a non-compete or a non-solicit back on January 1, 2021? Does this law obliterate that document? What's the answer? No, it does not. This law pertains to agreements entered into January 1, 2022 going forward, okay, prospectively, all right? And it also has other language that you need to include, like you need to give the person an opportunity to consult with an attorney. You need to say that. You need to give them at least 14 days to consider. And there's some other provisions. Just know, in terms of the spirit of issue spotting, if you're going now post 1/1/22 to give your employees any form of a non-compete or non-solicit, make sure you're talking to whoever you talk to who knows this law so that you're taking account of it. That's my message. Next slide. Health and safety, there's been a number of things. The Illinois Healthcare Right of Conscience Act. This is the amendments that's going to go into effect June 1, 2022. Governor Pritzker had moved to get this passed earlier. It didn't get passed, so it's going to be passed June 1, 22. In a nutshell, this allows individuals, at least through the end of May, or up till June 1, 2022, to rely on moral conscious objections still conceivably as it relates to COVID-related measures that employers still want to take, like vaccines and testing and other things. So it broadens the type of objections that an employee can assert beyond just religious and medical, and it allows them to rely on the broad net of moral conscious type objections. So I've had it for different clients of mine, particularly, in the past here. I will see how things are going to go going forward, but where a client's mandating a vaccine. And I've gotten letters from lawyers or employees where they're saying that under this Illinois Healthcare Right of Conscience Act, they're objecting to taking the vaccine or getting the vaccine or to be tested. So at least through the end of May, we should have this on our radar as employers. After that, that argument is going to fall on deaf ears in light of the way the law is going to be constructed. Okay. These next things here, I kept them in here, but they pertain to hotels. The reason I kept them in here is because I know sometimes we have restaurants that are in hotels, and I just wanted it on everyone's radar, but I don't want to take time talking about those next. Let's go to the next slide.
And Rob, just wanted to flag, it's about 2:20.
Okay. I'm going to go through, I'm going to talk even faster than I'm talking now. Okay. VESA is the Victims Economic Security and Safety Act. That's an Illinois state law similar to the Family Medical Leave Act. You'll see how that's been amended. The definition of family or household member has been expanded. The Unemployment Compensation Act in Illinois now provides that victims of crimes of violence shall not be barred from collecting voluntary leave benefits. Next slide. The Artificial Intelligence Video Interview Act is a new Illinois law. I don't want to spend too much time on that, but if you're an employer who asks applicants to record video interviews, know that this is out there and you need to comply. The Illinois Personnel Record Review Act is another one that you need to be mindful of. That's where an employee seeks their personnel file from you. And they have certain rights under that law. You have to be mindful that you shouldn't disclose disciplinary records of an employee to a third party without prior written notice to that employee. There's a change in the Illinois Employee Sick Leave Act, expands its usage to include personal care like the FMLA. Give me one more minute. I'm going to turn it over. Just want to get out the issue. If you use thumb scans or facial recognition, make sure you understand what the Biometric Information Privacy Act says. This is a very important law, okay? And quite frankly, unless there's a compelling business reason, I would not use biometric scanning as your time recording methodology. If you want to talk about it more, let me know, okay? And then take note of the different wage and hour laws. I can touch on the 80-20 rule, which is important for restaurants later, if you would like. That's an important rule that came down on December 28th of last year. It impacts the type of work that tipped employees can do. So I'm going to stop there and turn it over to what's going to be a great presentation from Plante Moran. And I will certainly be here for questions at the end.
Thank you, Rob. Really appreciate it. So yeah, let's go ahead and turn it over to Chad and Deanna from Plante Moran before we get to questions. And just a reminder, if you have any questions about anything that Rob was touching on, anything that he mentioned, please ask them in the chat. This is what we're here for. We've got the experts on. Want to try to get your questions answered. So feel free to put any questions in the Q&A now or throughout the presentation, and we will get to as many of them as we can at the end. So Chad and Deanna, please go ahead and take it away.
Thanks, Matt. Thanks, Rob. I really appreciate the introduction. And I just want to kind of get something clear as well. With Rob may have mentioned that our slides are, somewhat content heavy for you to be able to refer back to. But if we spark a question that we don't go into enough detail, please feel free to reach out to Deanna and I. We're always happy to help answer questions for IRA members via email or phone or however you want to get in contact with us. So right now we're going to go through some tax topics and really set the groundwork and look into what to focus on right now, because there's been a lot of changes across all industries, in specifically also the restaurant industry. And we're trying to frame, what opportunities are out there, what things to take advantage of versus what are your reporting requirements from a tax perspective, as well as a financial reporting perspective. So if you want to, so again, revisiting the COVID-related programs by year, one piece, and I'll say this, and I won't go, line by line, but in particular, the PPP loan, if you haven't filed for forgiveness through 2022, I think this is going to be an excellent opportunity because we're going to talk about the interaction with the employee retention credit. If you haven't filed and you're using more than 60% of wages, this is for that forgiveness is an excellent time to stop and reassess whether or not you also are eligible for the employee retention credit. Other items of the Restaurant Revitalization Fund, that's one of the ones that goes past the 2022 tax year. You actually have until March of 2023 to exhaust all of those funds. And again, the employee retention credit, while eligibility was for from the date of shutdown all the way through third quarter for by and large in general through 2021, you can still be filing amended payroll tax returns to get this benefit. It's not that all this time is already expired and you can't look back. I would encourage you to look and see whether or not you're eligible based on some of the things we go through. And then lastly, just one other piece of the employer payroll tax deferral. If you took advantage of this ability to defer your payroll taxes, that first payment was due, the 50% payment was due at the end of last year. Making sure you're making that payment before the end of this year for the remaining 50%. There are substantial penalties not to pay, but as long as you're taking care of that before the end of the year, there shouldn't be any issues. Do you want to advance to the next? Thank you. So really just want to framing by year. And there's been a lot since the Tax Cuts and Jobs Act back in 2017 to the CARES Act that happened towards the beginning of the pandemic, and several others, the infrastructure bill, the others that have an impact on your business and how things are reported, what you're eligible for. And really the interplay between all of them is important. because they all they correlate to each other, and you can in some ways have double benefit, which is a good scenario for specifically for restaurants who have been hit so hard by the pandemic. One piece on this slide that I especially want to touch on is, down in the net operating losses section for 2020, whether if you generated a large loss in 2020, there were some changes, some very favorable changes with the CARES Act that you could carry back those losses up to 5 years. And that's important for a couple of reasons. One, you could carry it back to prior to the Tax Cuts and Jobs Act, so to a higher income tax rate year, and ultimately be saving more money now. And then the second reason to be able to carry back is that's no longer an option with 2021 and forward. 2021, you're limited to the loss that you can take if you have one from your business because of all the pandemic related items. And your carry forward is also limited. So you only can use 80% on a carry forward basis. But that 2020 tax year, if you had a loss, I would encourage you to look back and see whether or not it makes sense to take that to a year of income prior to 2020 and get cash in your pocket sooner, because it could be several years before you eat into that loss. And we're seeing that across a lot of our clients right now. So we'd be remiss not to talk about the employee retention credit. That is one huge item. Go through an overview and then the income tax reporting if you want to pass through. So just to kind of set the bar, this may be repetitive for some of you, but the eligibility, whether you're, you are either subject to a shutdown governmental order or suffer a decline of 50% or more of grocery seats for 2020, compared to that same quarter in 2019. And for 2021, it's the shutdown order or a decline of 20% or more compared to those same quarter in 2019. The amount of the credit in 2020, up to $5,000 of a credit per employee in total for the year. 2021, they expanded that substantially. So through Q1, first quarter through the third quarter, you can get up to $7,000 of a credit per employee per quarter. And that while it's not available for the fourth quarter any longer, it is in most circumstances, if you're a startup business, and we'll touch on that here in the next slide, there's the potential to still qualify in the fourth quarter of 2021. And one thing that's really important, and we'll touch on in a few slides, is the coordination with other programs. I've heard a lot of restaurants say, well, we got a PPP loan, I don't think we're eligible for employee retention credit. That is not accurate. You are eligible for both. You just can't use the same wages for forgiveness of PPP and employee retention credit, the employee retention credit. You just can't use the same. And that applies also for restaurant revitalization fund utilization. So advancing to the next. So again, the governmental orders were largely eliminated in 2021 for all of us, in Illinois. It ended June 11, 2021. However, we've seen a lot of clients that have qualified because of a gross receipts reduction in the second quarter for all the second quarter. And if you qualify in the second quarter of 2021, you automatically qualify for the third quarter if you can be eligible for those gross receipts reduction in Q2. Now, the other piece of some also have said one misconception is that your gross receipts decline has to be related to COVID-19, and that's not the case whatsoever. Could be supply chain issues, lack of workers. It truly is your gross receipts, whether or not whether or not your business has been able to come back to those pre-pandemic levels. That's what we look at. And like I said on the previous slide, where the employee retention credit generally is through the third quarter of 2021, because the infrastructure bill that was passed in the fall removed the fourth quarter. You still can be eligible in the fourth quarter if you're a startup business that began operations after February 15th, 2020, and you have less than $1 million of annualized gross receipts, that you would still be eligible. So again, what you can do right now is take a look back retroactively and understand, did we look into the employee retention credit and were we eligible? Because if you haven't taken advantage of it, even if you've received PPP loans, there's potential that there is cash still out there that you could receive for your business, which is really, really important. And it's only done through an amended 941 payroll tax return. Just keeping in mind that you're appropriately coordinating with those other programs. Want to advance to the next slide? Oh, one back. Thank you. So again, PPP interaction, you cannot use the same wage expense for both PPP forgiveness as well as employee retention credit. However, if you remember on your payroll protection program forgiveness, you can use 60% of wages and still qualify for full forgiveness as long as that other 40% bucket is filled with these other defined costs. We've found quite a few clients that when you're only limiting to the 60%, that other 40% of wages that you didn't use, you could qualify for the employee retention credit. So while you had in first quarter 2021 PPP loan and you were working through that, there is a heavy potential that you could still be qualified for the employee retention credit, even though they're in the same category. It truly is about documentation, being able to analytically look at how these programs are overlapping with each other. And then as far as income tax reporting for employee retention credit, and this is an impact to you right now, and it was for 2020, you do have to reduce your wage expense for the amount of the credit. So if I got so one employee for one quarter in 2021, if I got a $7,000 credit, I get a refund of $7,000 on my payroll tax return, but I lose $7,000 of an expense on my income tax return. So I'm sure those of you that have applied for it, the frustration is the timing is a little bit off of, you have to file your tax returns, your income tax returns now, and the refunds are significantly delayed with the IRS. While we are seeing some of those 2020 filers starting to get checks, around 6 to 7 months, sometimes 8 months later, they are starting to roll in. Clients are getting notifications of cash. So if you did file last summer, your amended 2020, you should be looking out for that notification in the mail and hopefully receiving that cash back. And then one piece that we've seen that's missed or not as much light on is that even though you don't get the wage expense on your federal return, you do still get a subtraction in Illinois. So that $7,000 add back for federal purposes, you get a subtraction in Illinois. There's a specific code section in Illinois, you still get the subtraction. So you do not have to pay Illinois income taxes on that employee retention credit add back. Want to advance to the next. And before we get into the income tax reporting, because there's pieces of that, I want to push it over to Deanna to talk through a little bit of the financial statement reporting as well.
Thanks, Chad. And so the commentary I'm going to provide is mostly going to be applicable for those reporting their financials on like a US GAAP basis and how it may differ from kind of a tax reporting standpoint. So in the context of PPP, so for book and or GAAP financial reporting purposes, there's a couple different ways that companies can elect to account for the loans. And that impacts what period in which the income related to the forgiveness of the PPP loans can be recognized. So one of these methods is to treat the loan like a not-for-profit entity would treat a government grant, where that income is being recognized as the conditions of the grant have been satisfied. So assuming that as a restaurant, you're eligible for a PPP loan, you'd be recognizing the income relating to it as you're spending the funds on qualified expenses. And the other method is to treat the loans as debt. So, and then that income related to the debt would only be recognized as income once the loans are actually forgiven by the SBA. And so a takeaway I want to kind of leave you with regarding this is that with the various forms of support that have been out there, so like the PPP loans, the RRF grants, the shuttered venue grants, you have to be consistent in how you're treating these funds. And so if you're treating one of them as debt and taking the income when it's forgiven, or you have to just be consistent in terms of how it's treated across the board. So I would advise just consulting with your accountants or reaching out if you have questions, if you're unsure of which methodology to adopt or whether you're recognizing income for the proper period for book or GAAP purposes, if that's something that's even relevant for you. So I'll pass it back to Chad then to talk about the tax considerations as it pertains to PPP loans.
Thanks, Deanna. I think hopefully it's well known that the PPP loans that you're still, the expenses related to those are still fully deductible, and you don't recognize any taxable income on the loan forgiveness. So those things are really important. It's a really beneficial answer for taxpayers, which is on purpose, that you effectively get tax exempt income for your loan forgiveness, but still get the deductions related to it that qualified you for the full forgiveness, hopefully. So the timing, there's very favorable answer on that, on when you recognize tax exempt income for your tax return purposes. You can do it whether when your money was spent, when forgiveness was applied for, or when forgiveness was approved. There's a revenue procedure out there that is effectively, you just need to add a footnote to your filed tax return this year, stating whether, if you are applying it this year and recognizing that tax exempt income, you need to attach that footnote to identify what year it's related to, whether or not forgiveness has occurred, and that you are taking it for the 2021 tax year. And then just a reminder as well that not all states have adopted this treatment. So if you want to advance to the next slide, whereas in Illinois, which hopefully that the majority of us are being impacted, but if you have restaurant locations in other states, there are a few states that aren't fully allowing the tax expense, the PPP forgiveness to be tax exempt. California being one. You can look at the chart here. This is the most up-to-date from August of 2021, but that is one piece that has certain clients have been surprised by, that it's not consistent by the state. Most states have adopted the federal treatment, but not all. And then advance. So the last, one of the main topics here of just, state and local tax updates, and we can advance to the next. One of the largest pieces right now, because we talked for this last year of all the potential changes that were going to happen from the Biden administration passing large tax reform pieces. A lot of those, most of those did not occur. However, there are some clarifications and things that are related to previous tax proposals left. And one of those in Illinois is this pass-through entity tax election. So what is it and how does it work? So essentially, if you are a partnership or an S corporation, you distribute your income out to your partners or shareholders, and then they pay tax in Illinois for that income. Well, what this pass-through entity tax election does is it shifts the tax burden from the individual to the business. And that's important because if you want to go to the next slide. So that's important because back in the Tax Cuts and Jobs Act in 2017, there was a $10,000 state and local tax deduction limitation for an individual. That there were other pieces that would fall in, but now if you have, associated with your business, if you have $50,000 of state taxes associated with your business, you effectively weren't able to deduct 40,000 of them. So what this does, and there's not every state has adopted it, and there's a lot of things going into this, but effectively what it's doing is taking that, instead of paying 50,000 at the individual level and 40,000 being non-deductible, you're shifting the full $50,000 payment to the entity and taking a federal deduction and paying the Illinois tax on the behalf. So it's a way that has been effectively blessed by the IRS to say that you aren't subject to this $10,000 limitation at the business level. Let's go on to the next. So the question is, will the business qualify for an election? How is the election made and the timing? So in Illinois, you make the election with the filing of your tax return, but other states are different. So there's about 23 states that have created a similar approach to this business entity level tax as a way for the $10,000 workaround, but not every state is the same. So for the most part, when we're talking with people in Illinois, it really is a filing with the return. That is when the election is made. That's when the payment is made. So if you were an S corporation, you had an extension due on March 15th, you can still make this payment when you file the return if you haven't filed yet. And for a partnership, you either need to make the payment or the extension payment by April 15th, or it needs to be, but the election is technically done when you file the return. So if you do extend the return, it doesn't extend the time to pay, but you should be making that payment by April 15th if it makes sense for you. So, what are the implications? And there's a lot of questions around it. And I would say that it's a case by case, but in general, if you are all Illinois, if you have only Illinois partners and shareholders, and you're an operating business like a restaurant, that it is a very favorable treatment. And all it's really doing is, instead of making a cash distribution to those partners or shareholders to pay tax on their own, you are now paying the tax at the business level and getting an additional deduction for it. So again, I'm oversimplifying, but this is one of the largest considerations, and you can advance to the next slide, for 2022 and beyond. And it does apply for the 2021 tax year, is the first year that you can make this election on. So there's one kind of discrepancy if you do have audited financials, and I'll let Deanna jump into this. There's just a different type of reporting for tax versus GAAP.
Yeah, and so, and also not even necessarily. So this is something where there's even in the kind of book GAAP accounting world, there is not consensus on how to treat the tax election. So there are some firms that are advising their clients to treat the paying of these taxes as a distribution. So it's saying that the restaurant is paying these taxes, that is actually the responsibility of the owners or the investors on behalf of the owners, and such transaction then could be treated as a distribution. And then the other way is more in line with what Chad was saying in terms of treating it as if it was a company expense, which would then run through the company's P&L. There's also some discussion about the timing of that. So if it's 2021 expense, but the company did not elect to take that deduction until they filed their return in 2022, they would not necessarily be on the hook yet in 2021 for those expenses. So kind of as I noted earlier, again, because there's inconsistency even between accounting firms as to how to treat it currently, I would definitely advise reaching out to your firm or to us if you have any questions on what to do with the election.
And just the last piece on this one, on whether it's you think that it's an impact or not, I would encourage you to ask your tax accountant about this, because they should be making an active determination on whether or not it's a benefit to you, your partners, and your shareholders. I'm going to advance to the next. And then a little bit of planning. So we touched on the employer retention credit, that if you haven't taken advantage, you should be looking into that right now. The pass-through entity tax we just spoke on. The other pieces are things that have kind of already been in motion, but just important to make note of. One thing that the Tax Cuts and Jobs Act did do, so if you are, fixed assets right now, you can effectively take 100% write-off through bonus depreciation when you place it in service in a given year, as long as it's qualified improvement property or personal property. And going forward, so 2023 and beyond, you're not getting that same full deduction for tax purposes. So it's something to keep in mind. If you're in the middle of needing to have if you're in the middle of a renovation, an expansion, some sort of capital investment into your restaurant, getting it done in the 2022 tax year as it currently stands would be more beneficial. You would get a larger deduction than delaying it until opening until 2023 and beyond. And then also a piece of it just want to touch on cost segregation, historic tax credits, new market tax credit, employee enterprise zone program. The cost segregation, generally, if you're opening a new restaurant or open more recently, if you bought a building and all of the furniture and fixtures inside of it for your restaurant, there's specific ways that you can accelerate deductions through a cost segregation study. For example, if you pay $100,000 for a space and there's $20,000 worth of furniture and fixtures that you buy, without a cost segregation study support, you may be limiting how much you're able to deduct in a given year. So again, it really applies when you're buying something new with items already inside of it. a new space. And then the enterprise zone program, again, if you're building in an enterprise zone, you can look on the Illinois website of where these enterprise zones are. There's a ton of exemptions on building between sales tax on purchase of personal property, state utility tax for electricity and natural gas exemptions. There's a lot of good benefits. So if you are in the process of building a new restaurant that's going to open in 2022, one, invite Deanna and I, because we'd love to be there. And then also look whether or not you're in an enterprise zone, because there's some favorable areas that you already are in, and it's just taking advantage of those locations. Then the last piece, and this is really important, and it was brought up in President Biden's State of the Union address as well, and he's talked about it. They're putting substantial resources to investigate pandemic-related fraud. And the key takeaway from that is that you should make sure that your documentation is in good shape, that you're very clear on the deductions that you're applying against, because there is the potential that there could be more audits in the future, even after forgiveness is done. And we just want to make sure that you're doing it on the front end, instead of trying to do it, 2 years from now, trying to find support for a few years back. So that is one piece. And then from that, he's also, there's a lot of money that has gone into IRS infrastructure, which hopefully decreases our wait times on things, but it's also to their fraud investigative unit. So there will be more audits in the future first they'll relate to pandemic related fraud. And then just in general, there's going to be more IRS audits that unfortunately you'll have to go through. Hopefully that's not the case for any of you, but if it is, that is something that, again, just continue to have the right documentation and ready to go. And really those were the main items from Clemmer. And yeah, Matt, I'll kick it back to you to start the Q&A.
Great, thank you, Chad. Thanks, Deanna. A lot of great advice and considerations for tax time, so appreciate it. We've had a lot of good questions come in. We've got about 15 minutes left to go through them, so let's go ahead and get started. As a reminder, please feel free to ask your questions now in the Q&A. We'll get to as many of them as we can. So question for Rob. Rob, you had touched on this. Maybe if you can reiterate, for the Illinois Equal Pay Reporting Act, when will I know when I'm required to report to the state? And Rob, you're on mute.
Sorry, Matt. Well, you should ideally, from what I've been hearing, because I've had certain clients get them already. You should be receiving I believe it's an email from the state, the Illinois Department of Labor, saying that basically it's your turn now, employer or restaurant. In other words, this is a requirement, that this Equal Pay Act certificate, we're giving you until blank date to submit the certificate with the supporting documentation. And should be other information in there as well. So in summary, in the perfect world, from what I'm hearing, they meaning the agency, will initiate the request to you. But as I was saying earlier, if time passes significantly, remember the first 2-year period is March 24, 2022 to March 23, 2024. So if time passes significantly and you haven't heard anything, and you know that you're an employer that has to comply with this, I would reach out to them at some point. The other thing that's important, and I'm glad the question came up, you may be thinking, well, what if I have less than 100 employees? Do I have to do anything? Is it, because remember I said 100 or more employees in terms of the EEO-1 reporting obligation is what triggers the need to comply with this amended Illinois Equal Pay Act piece. Well, if you have under 100 employees, you cannot just sit back and do nothing. There's a provision in there, and if you want, look on their website, but you have to affirmatively let them know that you have under 100. Okay, and that's why you're not complying. Next slide.
Thanks for clarifying, Rob. And that's what we've heard on our end as well. It's not ideal that you do have to wait for the department to be reaching out to you, but if we hear anything differently and as we receive updates from the Illinois Restaurant Association, we will certainly share those with everyone. So question for Chad and Deanna, if I received RRF, is it seen as taxable income in the state of Illinois or federally?
is not taxable in federally. It's similar to a PPP loan forgiveness as long as the costs are tax deductible and your RRF funds are also tax exempt. For Illinois, while there hasn't been a specific determination of outward posting, it's not included in your tax base for federal purposes. So we also believe that it would not be taxable in the state of Illinois, and have not seen anything contrary to that fact.
Thanks, Chad. We've at the IRA, we've also been told that by the state of Illinois as well, that as long as it's not considered taxable by the feds, it would also not be considered taxable at the state level. So thanks for clarifying. Question for Rob. Rob, this is a question on minimum wage. Are there Cook County suburbs allowed to exempt themselves from Cook County's minimum wage law?
Yeah, there are certain suburbs that can and have exempted themselves from both the minimum wage piece as well as the paid sick leave ordinance or the earned sick leave ordinance. So my firm, we keep a running list of those because they evolve over time. And there's been instances where we've had municipalities in Cook counties who have initially opted out of one or both those things, and then they've subsequently opted back in. So you need to pay close attention because as we became accustomed to in the world of COVID, where the CDC and state and local authority guidance was changing every day or by the minute, this isn't quite as bad, but it is an area that changes and evolves. So make sure, if you're not sure whether or not the municipality that you are in is following them or has opted out, make sure that you get a good answer on that, because that's obviously an important question.
Thanks, Rob. Yeah, I'd also add, definitely check with your local municipality on that, because the Cook County's minimum wage law has been in effect for quite a few years now. And I remember at one point, there's 100+ municipalities in Cook County, close to 100 or at 100 had opted out of it. But as Rob said, that changes. Sometimes they change their mind, vote to opt in at a later date. So definitely check with your local municipality as well. Chad and Deanna, are there restaurant grants I need to file a 1099 for on my taxes?
No, I'm not aware of any that require a 1099 filing.
All right, that's an easy answer. So let's see. Question, and maybe if you could, Chad and Deanna, if you could share a little bit more insight about what you're hearing on the timing of the ERTC, which just on my end for everything is super delayed. As you said, people are still waiting for the 2020 credits. The question here is, well, there's a couple questions on the ERTC. For the months that first question, for the months that we are eligible for the ERTC, are those eligible months, cannot be deductible for payroll? Is that making sense?
Yes. So sorry, you have to. So I think so. I'm going to interpret the question that if you are eligible or you're required to take it, are those expenses still deductible? You have to apply for the employee retention credit and receive it in order to be limited on the deduction. And it's only up to the credit amount. So in the example of 2021, $10,000 of wages, $7,000 credit. Only $7,000 is non-deductible for wages. For IRS purposes. For Illinois, you get a subtraction. But if you don't apply for the employee retention tax credit and you don't receive it, then there's no overlap. You don't automatically apply into it.
Got it. Thank you, Chad. And then another question here. I had an ERTC PPP question. I had applied and got approved for second round of PPP covering Q1 of 2021. Is it possible to push the covered period forward to Q4 2021 so as the ERTC claim for Q1 remains unentangled by PPP second round?
So your limit on PPP, your covered period is dictated by very specific rules on when it has to start and begin. Really, it started when you receive the funds. You can go to your next payroll. There's a couple of taxpayer-friendly observations, but ultimately, it has to be you have that time period limitation. So you wouldn't be able to just change your covered period later in the year, unfortunately. But again, look at that overlap between the 60-40 piece, because there could be potential where you are eligible for both.
Understood. Thanks, Chad. And then where do you recommend if folks are still just waiting, haven't heard anything in several months on their ERTC application and its status, where can they check or who can they reach out to?
That's a great question. I will say this there's unfortunately, frustratingly, not a line to call on the IRS. You can't check your place in line. Effectively, you can't determine until they've processed the 941, or you can only, so I would encourage people to send in their amended returns either electronically or via certified mail so that you can determine when the receipt date is, and know that it's been very frustrating, the length of timelines that our clients have been waiting to get refunds back, but we are starting to see some refunds from the IRS, particularly those from who filed last summer. Those are starting to come in, so it gives us a little bit of hope. And the IRS is applying additional resources to work through the substantial backlog of amended returns.
Understood. Good to know. Rob, what would you say is the most significant labor law liability that you're seeing restaurants face right now? What are they getting caught up on, getting into trouble with, that people need to be aware of?
I still would think that, and I'm just pausing for a second, but I there's it's close sometimes, but I still think that the single most issue that I know sort of keeps me up in representing these type of clients and other types of clients is the wage and hour type issues. I think that particularly with restaurants and other hospitality employers that don't have the advantage of having human resources and other resources to pay attention to this sort of thing, that there's all sorts of ways to just be direct that this can be screwed up, whether it be through not adhering to the different minimum wage laws because you don't know which one applies. You have different establishments maybe, or just not keeping up to date on the changes as to what the current rates are. It could be not calculating overtime correctly on tipped employees or tipped workers, not knowing how to do that. Now, your payroll company, if you use a reputable payroll company, they of course should know how to do all this. But I will tell you that this is no knock on any of the payroll companies. I work with many of them for my clients. Okay, that's not, but you should check every so often, audit it, because you'd be amazed how time goes and anyone could make a mistake. So just audit them from time to time to make sure that overtime is being appropriately calculated. Now with this 80-20 rule, there's opportunities to mess up whether or not you need to pay the full minimum wage to a tip credit employee or the tip credit rate. Okay, that's another avenue. So there's and then the other one I've been involved in many times on behalf of restaurants is where restaurants or other hospitality employers potentially misclassify certain mid-level managers or other types of more white-collar type positions as exempt from the overtime laws, when in fact, when you look at what they do, they're really non-exempt. And I've become embroiled in many disputes over those sort of issues. So I would have to say, bringing it full circle, Matt, wage and hour, that broad category, there's so many different ways that you could trip up. Oh, the other one, I'd be remiss if I didn't mention it, is if you don't know how to lawfully establish a tip pool or a tip sharing arrangement. I get involved in those sort of issues all the time. So there's all these different landmines that restaurants can step into, not because they're bad people, not because they want to violate the law, just because, gosh darn, it's hard enough for someone who does this to stay on top of all of it, let alone someone whose business is not in the wage and hour area.
Understood. Thank you, Rob. I guess same question for Chad and Deanna. What are the biggest accounting tax liabilities that you're seeing right now and people really, really need to be aware of for your clients?
Yeah, Matt, honestly, there's been, and we touched on it a little bit, there have been so many changes to tax law in the last few years, the interplay between all of them. We've seen a number of people we've talked with about, even on some of the old of not properly filing their FICA tip credits, or having the wrong depreciation. There's real issues on these changes that not everyone is keeping as up to date with. And sometimes we're seeing people who are overpaying a tax liability because there's been a favorable change that their accountant unfortunately just hasn't been as up to date on. So those are some of the bigger issues right now from an income tax standpoint. And just there's going to continue to be, there won't be as much changes, we don't believe, in the future, at least in the short term, because of just legislative and a little bit of blocks there. But I would continue with we know that the IRS is continuing to be funded much more heavily. There's going to be more audits in the future, making sure documentation and people are just filing things correctly. Because all of these changes that the IRS is doing, it's making it easier for them to audit individuals' businesses, individuals' returns, and you could get a lot more automated notices in the future that really cause a lot of excess headaches if you're not doing things right.
And something from sort of the book side, or if you that's coming down the line, or I guess it's kind of already here right now. So there's a new lease standard that's going to be effective for fiscal years ending 2022, so basically this year, that would potentially impact restaurants if you're doing GAAP reporting, and especially restaurants that have bank debt with financial covenants. So with the implementation of these new lease standards, it's going to impact things like your current ratio, debt to net worth or leverage ratio, your debt service coverage ratio. So you'll definitely want to make sure that when you have the discussions with your bankers over the covenants of your loans, that those considerations are taken into account.
Understood. Thanks, Deanna. Thank you, Chad. Well, listen, we're at just after the hour. We appreciate all of you for being here, and thank you for being here as experts to share this very important information with our members and operators throughout Chicago, throughout Cook County, throughout the state of Illinois. So I'd like to thank everybody for attending, and thank again once again our panelists: Rob Bernstein, partner at law firm Langer Mushin, Chad McCoy and Deanna Chang, both senior managers at Plant Moran accounting firm. I'd also like to thank the Cook County Small Business Assistance Program for their continued efforts to provide free online resources, events, information, and coaching to small businesses. As I noted before, following the conclusion of the webinar, attendees will receive an email with links to the webinar recording as well as the presentation. Recording will also be made available at the Illinois Restaurant Association's website, so please feel free to check it out there, as well as many other resources for Illinois restaurants, hospitality businesses, and allied partners. Thank you all for attending, and have a great day.
Thanks, everyone.
Thank you.